Welcome to Master the Case. This tutorial will teach you how to solve a profit improvement case from the cost side of the profit equation. Our key topics are as follows: performing a profit source analysis to isolate the cause of a profit decline, segmenting cost components to identify the main areas of cost escalation, examining key cost drivers to determine feasible avenues for cost reduction, and using the stable perpetuity formula to determine the NPV of an action plan. Let's now master solving a profit improvement case.
Our client is Polychem, a mid-sized U.S. chemical company. The client produces and distributes a commodity compound. Polychem's profit margin has declined from 5% to 0%, and the CEO needs our help to regain the profit margin. How can you help the client?
I'd like to recap my understanding of the case. The situation is that our client, a mid-sized U.S. chemical company, has suffered a profit margin decline from 5% to 0%. The complication is that the client needs our help to regain the lost margin. So our primary question is, how can we regain profit margin? Is this a fair summary of the case and its primary question?
Yes, it is.
Before forming my initial hypothesis, I'd like to ask two clarifying questions. First, is the problem client-specific or industry-wide?
It is client-specific. In fact, the overall industry is quite healthy, with stable demand for its products.
I see. And second, does the client have a specific timeline for profit improvement?
As soon as possible.
Clear. Can I take a minute to develop my initial hypothesis and analysis plan?
Sure, take your time.
Thanks for the time. I'm ready. In order to answer the primary question, my initial hypothesis is that we can regain profit margin by reducing costs. My main rationale is that because the industry demand is stable, it seems unlikely that revenue, the other profit driver, has declined, causing the margin erosion. In order to test the hypothesis, I will analyze 4 key issues. 1. Can we explain the profit decline? It is critical to do that before we can develop an effective plan to improve profit. In this area, I will look at 3 sub-issues. Can we isolate the problem profit stream? Have costs increased? And has revenue declined? 2. Can we reduce costs? In this area, I will look at 3 sub-issues, focused on the key cost drivers. Can we reduce the volume of inputs? Can we reduce the unit cost of inputs? And can we improve the input mix? 3. Can we grow revenue if reducing costs turns out to be difficult? In this area, I will again look at 3 sub-issues, focused on the key revenue drivers. Can we increase volume? Can we raise prices? And can we improve the revenue mix? And finally, 4, can we justify it, that is our plan, financially? Before I start my analysis, I'd like to check with you if this plan makes sense.
It does. Go ahead.
So our first key issue is, can we explain the profit decline? To answer it, I will analyze 3 main sub-issues. 1. Can we isolate the problem stream? 2. Have costs increased? And 3. Has revenue declined? So we know from the initial data that our margin has declined from 5% to 0%. What is the size of the profit decline in dollar terms?
$10 million.
I see. Next, does the client have multiple profit streams?
No.
So the client has a single profit stream that's declined by $10 million. Next, I'd like to determine the driver of the profit decline. Do we have data on how the client's costs and revenue have changed?
Sure. Costs have increased and revenue has remained constant.
So we do have a cost issue as hypothesized. I'll cross off revenue and focus my further analysis on costs. Next, I want to identify the main component costs. Do we have data on the client's total costs and how they are segmented?
Total costs are $200 million with three main components. Raw material cost, 70% of total, processing cost, 20%, and labor cost, 10%.
Interesting. Raw material cost is the dominant component with 70% of the total. That's worth highlighting for further prioritization. Now, I'd like to compute the dollar values of each component. So that's $140 million in raw materials, $40 million in processing, and $20 million in labor. Next, I'll determine if the total cost increase is isolated to an increase in a specific cost. So, do we have data on how each of these costs has changed?
Yes. Raw material cost has increased by $10 million. All other costs have stayed the same.
I see. So, we have now isolated the client's entire cost increase to raw materials. At this point, I'd like to synthesize my learnings and outline next steps. Having explained the profit decline, I'd like to refine my initial hypothesis. Specifically, we can regain profit margin by reducing the cost of raw materials. The rationale for that is twofold. One, raw material cost has increased by $10 million, driving the client's entire profit decline. And two, raw materials account for 70% of the client's total cost, representing the highest potential area for cost reduction. In order to test the hypothesis, next I will analyze if we can reduce raw material costs. So our next key issue is the market attractive? To answer it, I will analyze two main sub-issues. One, does it have strong fundamentals? And two, does it have attractive customers? First, just to confirm earlier data, the target primarily operates in Europe, doesn't it?
That's right. Unlike our client, which has a global reach, the target focuses on Western Europe.
Okay. And do we know how big that market is in order to test if it has significant size to appeal to the client?
We do. The Western European air travel market is worth £80 billion.
I see. And just to put that number in perspective, considering our client's global reach, how big is that as a percentage of the global market?
About 20%.
Okay, got it. Next, I'd like to determine if the target's market offers consistent growth. Do we have data on its past or projected development?
Yes, we have the following information.
Okay. Can I take a moment to understand the graph before analyzing it?
Sure.
So, the graph contains data on regional air travel growth rates. The x-axis is in percents, on the scale from 0 to 8, and it actually refers to a 10-year compound annual growth rate forecast. And the y-axis plots different regions in descending order according to growth rate. So to synthesize my understanding of the graph, it essentially ranks the different regions of the world in terms of their forecast annual travel growth over the next 10 years. Am I reading it correctly?
Yes.
Great. Next, I want to analyze the graph data specifically to test if Western Europe offers attractive growth prospects to the client.
Before you do that, can you estimate the average growth rate across all regions?
Sure. I can see that the distribution of growth rates is quite balanced, with no outliers. So I'll use a shortcut by adding 7.5% at the high-end extreme and 4.1% at the low-end extreme. The sum is 11.6%, which I will further divide by 2 to get 5.8% as my average growth estimate.
That's pretty close. The exact answer is 5.5%.
Good. Let's plot it on the graph. So now let's see if Western Europe offers attractive growth prospects to the client. In fact, I can immediately see that Western Europe, along with North America, is below average. On the other hand, Asia Pacific and Latin America are above average. That's interesting. Based on these growth rates, I would argue that the client will be better off prioritizing these two markets and reallocating the target's Heathrow slots to serve them. Is that something the client can do post-acquisition?
Yes, as long as you own the airport slots and have the right type of aircraft, you can do that.
That's good. Let's note our learnings and analyze the remaining sub-issues. So, while the average global air travel growth is around 5 to 6%, the Western European growth is about 4%, below average. Moreover, on the global level, we've identified two attractive priority segments, namely Asia Pacific and Latin America, with growth of 1.5 to almost 2 times versus that of Western Europe, where the target currently operates. So next, I want to probe deeper into these priority markets and determine their customers' attractiveness through the following questions. Do they have unmet needs that we can target post-acquisition? Do they have willingness to pay, ideally premium prices, to get their needs met? And finally, do they have propensity to switch from their existing air travel alternatives?
Sounds good.
First, do we have data on the key unmet consumer needs in those regions?
We do. The client has identified two such needs. One, non-stop travel to Western Europe because there are very few direct flights. And two, safety and comfort because airline safety and service are major issues there.
Interesting. Being a full-service airline, I am sure that we can meet both of those needs. The question is, do consumers have the willingness to pay our premium prices? Do we have any data on that?
Yes. The client's data suggests that consumers are willing to pay premium thanks to two factors. One, economic growth in those regions drives incomes. And two, Western European airlines have a great degree of prestige there.
That's good. In that light, my hunch is that consumers will have a high propensity to switch from their existing alternatives if we offer them new direct routes to Western Europe and meet their safety and comfort needs better.
Yes, that's a reasonable synthesis.
Great. So my final question here is whether the client has done any projections on the revenue upside offered by potential reallocation of the Heathrow slots from Western Europe to the two priority regions.
Yes, the client has done some forecasting, which suggests a 20% revenue upside from the same airport slots.
A 20% revenue upside from the same slots is quite significant.
What do you think is the upside in monetary terms?
Well, based on the target's revenue of £800 million, a 20% upside would be £160 million.
Good. So what's next?
At this stage, I'd like to synthesize my learnings again and describe next steps. So our next key issue is, can we compete effectively, with focus on our priority vodka segment? To answer it, I will analyze three main sub-issues. One, is the competition structure favorable? Two, do competitors have unique advantages? And three, do other industry forces pose threats? Let's start with the competition structure. Are there any dominant competitors in the UK market?
The competitive landscape is as follows. The market leader has a 45% market share. The follower has a 15% share. And all others have a combined 40% of the market.
Interesting. How fragmented is the 40% of the market that's not controlled by the top two players?
It's highly fragmented, with dozens of small players.
I see. Based on that, my hunch is that we should avoid competing directly with the top two brands and instead target the fragmented 40% of the market with unique positioning.
That makes sense.
Good. So next, to test my hunch, do we know if the leaders focus on specific segments, which we should avoid?
Well, the leaders are both Western brands that have a clear Western image focus, which is all about glamour and celebrity.
Aha. And do we know if any player owns what I call Eastern heritage positioning, which is distinctive from that pursued by the leaders and fits our brand well?
No. No player as yet owns the Eastern heritage positioning in the UK. In fact, the Russians have tried it, investing large amounts of cash. However, they ultimately failed due to lacking the right marketing skills.
Great. It seems that the competition structure is favorable if we avoid confronting the leaders. Next, I want to test if competitors have any unique advantages in terms of a unique marketing mix and strong internal capabilities.
No, we don't think so, and can skip this analysis.
Okay. Finally, I want to determine if other industry forces pose threats.
What other forces do you mean?
Well, there are 3 additional forces that can have an impact on our initiative. 1, other entrants and substitutes. 2, suppliers. And 3, macro factors.
I see. On the first point, the entry barriers into the UK are low, so there could be other entrants. However, none of the potential entrants, or substitutes for that matter, that we know of can match our quality.
That's good. Next, suppliers. Do we have to deal with powerful suppliers that can have a negative impact on our costs?
No.
Okay. And finally, macro factors. Are there any negative economic, political, and other overall dynamics that might hamper the success of our entry?
Actually, the macro factors are quite positive. Since Poland joined the EU, a substantial number of Poles have migrated to the UK. As a result, there is now a large Polish diaspora in Britain.
I see. So, in a way, this large diaspora can serve as our initial customer base.
That's right. The grocery industry statistics indicate that Poles in the UK tend to buy authentic Polish goods imported directly from Poland.
Great. At this stage, I'd like to synthesize my learnings again and describe next steps. So our final key issue is, can we justify the defense financially? To answer it, I will analyze 2 main sub-issues. 1, do we have a specific financial objective? And 2, can we achieve the financial objective? I recall from the start of the case that the client's specific objective for its defense is to maximize profitability. So what is the financial metric that the client uses to measure it?
Gross profit.
Got it. And in terms of how the metric is computed, is it simply revenue minus COGS?
Actually, it is net revenue minus COGS.
Interesting. How does the client define net revenue?
It starts with gross revenue, which is the invoiced customer orders, and then deducts bonuses and commissions paid to customers and sales force, respectively.
I see. So in other words, net revenue equals gross revenue minus bonuses and commissions.
That's right.
Got it. And just one final thing to clarify. The client's pricing that you shared before, was it on the gross or net revenue basis?
Net revenue basis.
Clear. So now we can move on to the next sub-issue and analyze the following 3 elements. What is the direct financial result? What are the additional synergies? And what are the key risks? I will structure my scenario analysis as follows. First, I will compute the benchmark current gross profit. Second, I will calculate the ignore scenario gross profit. And finally, I will determine the respond scenario gross profit. For simplicity, I will perform this analysis on the batch basis.
Sounds good.
So for the current gross profit, I will start with net revenue and subtract COGS of 60% to arrive at gross profit of 40%, as established earlier. So plugging in the numbers, $1,000 minus $600 equals $400 of current gross profit. These figures will form the basis for calculating the other two scenarios.
I am with you.
Next, the ignore scenario. Here, my logic is as follows. I'll start with the previously calculated net revenue minus 30%, because in this scenario, volume will decline by 30%. Then I will subtract COGS, for which the logic is a bit more complex, because on the one hand, volume will decline by 30%, reducing COGS. And on the other hand, the unit cost will increase by 15%, driving COGS up. So let's figure out the resulting COGS dynamics down here. In order to do that, I will start with the volume index and multiply it by the unit cost index to determine the COGS index. So plugging in the numbers, we know that volume will decline by 30%. So the volume index will be 70%. Next, we know that the unit cost will increase by 15%. So its index will be 115%. Therefore, the resulting COGS index will be close to 81%, implying a 19% total COGS decline in this scenario. So let's plug that into our scenario logic. As the final result, I will arrive at the new gross profit for the scenario. Does this logic make sense?
It does.
So plugging in the numbers, $700 minus $486 equals $214 of gross profit. That's an almost 50% decline versus the current level.
I'm following you.
Finally, the respond scenario. Here, the overall logic is a bit more complex because of the following three factors. 1. In terms of the revenue driver dynamics, both volume and price will decline. 2. In terms of the gross profit calculation, two extra variables, bonus and commission, will have to be taken into account. And 3. In terms of the COGS dynamics, it will be similar to that in the ignore scenario. Let's figure out the revenue driver dynamics first. In order to do that, I will start with the volume index and multiply it by the price index to determine the revenue index. So plugging in the numbers, we know that volume would decline by 10%. Hence, the volume index will be 90%. Next, we know that we'll have to reduce prices by 20%. So the price index will be 80%. Therefore, the resulting revenue index will be 72%, implying a 28% revenue decline. So let's now lay out the full response scenario logic. I'll start with the previously calculated net revenue minus 28%, reflecting the revenue dynamics calculated below. In fact, this should be gross revenue, as it'll be subject to bonus and commission. Next, we'll deduct the loyalty bonus, commission, and COGS, which, just like in the ignore scenario, must be carefully considered here. Specifically, the volume index of 90% times the scenario unit cost index of 105% results in the COGS index of close to 95%, implying a 5% total COGS decline. So let's plug that into our scenario logic. The final result will be new gross profit for the scenario.
Makes sense.
So plugging in the numbers, $720 minus $20 minus $50 and minus $570 results in $80 of gross profit. Let's now step back and review our results. Interesting. The ignore scenario gross profit is actually higher than that in the respond outcome, disproving my working hypothesis to respond to the threat. Therefore, we should ignore the new entrant. Let's note our learnings and analyze the remaining sub-issues. So the direct financial result is that ignore maximizes gross profit at $214 per batch. Next, do we expect any additional synergies either on the cost or revenue side?
No.
Okay. Finally, I want to highlight the key risks associated with our plan, which are twofold. One, bigger volume decline and cost rise than projected, further eroding profitability. And two, attacks in the electronics and automotive segments by this and other new entrants, encouraged by the lack of market leader response in construction.
Yes, the second one is a key strategic risk. So, are you now ready to wrap up the case?
Yes, I am.